Hey guys, welcome back. Johnny here, and in today's video we're going to go over the top 5 REITs that you should buy that have dividends over 5%. Now this was published on May 8th by Matthew DeLayla, and you can find this article on the Motley Fool or www.fool.com. So let's get into it. These REITs offer investors above average dividend yields. Now, the REITs that we're going to focus on right now, you can just look at and go on about your business, are EPR Properties, SL Green Realty, Medical Properties Trust, Store Capital, and WP Carey. Now, we're going to go over each one. It's going to be about a 5-minute video or so. So stick around to the end because the last one is really awesome. And don't forget to smash that like button and subscribe if you haven't already. So the Great Income Experience is what they're calling it. EPR Properties is a specialty REIT that specializes or focuses on real estate like movie theaters and attractions. Now this is really cool. It leases these properties back to the operator under a triple net lease. A triple net lease. Yeah, you heard that right. So those rental agreements produce reasonable, steady cash flow to support its 6.3 dividend yield per month. So this is a 6.3 annual dividend yield, but they pay out monthly. The REIT has sensible dividend payouts ratio of 75% of its adjusted funds for operation. Now, meanwhile, this is a solid investment grade balance sheet. These features give it a financial flexibility to purchase more experiential real estate, which should grow cash flow to support future dividend increases. Sorry guys, I haven't done this in just a little while, so bear with me. The REIT has already increased its payout by 10% this year, with expecting to acquire $500 million to $700 million in properties in 2022. It should have plenty of capacity to grow the dividend in the future. So let's look at the 5-year chart real quick. As you can see, major sell-off. You could have got this company for a nice price here. Looks like about, a little less than $18. I think it was $15. 52-week low saying $41.56. We could look at the max life. So it's hit some bottoms recently, but it's going up. Also, its highs look good, up in like the 80 mark. Looked like it hit $82 August 1st, 2016. But if we look at the 3-month chart, as you can see, it's steadily increasing and going up. Current price is $50.48 as of this video. It has a PE ratio of 33, which is nice. I like to invest in companies that have a PE ratio of at least 25 or better. 25 or better. I like that. I like companies that are steadily increasing up. So for this one, yes, I believe EPR is a strong company to buy. I have shares of this company in my portfolio as well. So moving on to the next one, steadily rising to the sky. Now they're saying that SL Green Realty is the largest office landlord in Manhattan. It owns some of the top properties in the city. With high demand, even more companies move to hybrid workforces in the future. Because of that, rental rates and occupancy levels have held up reasonably well, providing the office REIT with the income to support its 5.3 dividend yield. Now this is a monthly paying stock, so you could see returns as soon as next month. Now SL Green recently increased their payout by 2.5%. It's 11th straight year of dividend growth. This company is steadily increasing those dividends over time, and because of that, they've recently made their first office acquisition, buying 450 Park Avenue for $445 million. Meanwhile, it's moving forward with One Madison Avenue development project, which recently secured IBM as an anchor tenant for the property and sold another interest in the $2.3 billion development in joint venture properties. Now, this is great for them because it has an opportunity to combine the recovery in the Manhattan office market, and that should help grow the cash flow, enabling them to continue pushing those dividends even higher in the future. Now, with that said, I think that is a great company to get involved in, SL Green. Now, moving on, the Medical Property Trust, MPW, is a healthcare REIT. Now, these focus on hospital properties. They lease facilities back to their operator under the triple N agreement, which is the triple net lease agreement. That supplies it with a steadily rise cash flow to support its 6.3 dividend yield. Now, it didn't say monthly on here, so I'm assuming this is probably a quarterly paying stock. The REIT has increased the payout for the last 9 years, so it has been steadily increasing its dividend payout because of its expansion in the hospitals. Medical Properties currently expect to invest $1 billion to $3 billion on acquisition this year, which means that they intend to fund their asset sales and joint venture agreements, while recycling strategies will eliminate the need to dilute existing investors, which should boost its FFO per share, which should help the long-term stability and improving the high-yielding dividend. In 3 months here, as you can see, it hasn't done too much. It's just kind of slowly went down. It's a little steady over the 1-year chart. 5-year chart, it has gone up. It looks like it would be a good time to buy now at the $17 range, because a 52-week high was up in the $24 mark. Now, the PE ratio is only about 9.5. So, do your due diligence on this medical property trust, and just know to do more research on that one if needed. So, supported by profitable stores. Now, Store Capital, if you don't know, is a retail REIT. Now, they focus on retail properties that are freestanding, secured again by the triple N leases, which is the triple net lease. The company takes a unique approach by focusing on unit level profitability of stores it acquires. Focusing on purchasing profitable locations has enabled the REIT to deliver superior portfolio performance to help its tenants, because tenants are willing to continue paying rent on these locations. So by having prime locations, storefronts, corner lots, all these different areas that have high traffic, they're able to get the tenants to pay those triple net leases in order to stay at those properties. Now, Store Capital currently pays a 5.6 dividend yield and has increased by 6.2% compound annual rate since its initial public offering, which, geez, its initial public offering could have been, it looked like it was back in 2014. So it has been going up for the last 8 years. The company has an expensive addressable market with an estimated 2 million retail locations it could acquire in the future. Meanwhile, it has a strong balance sheet and a solid dividend payout ratio, giving it ample flexibility to continue growing its store count and dividend yield in the future. Now, their market cap $7 billion. Their current price is $26, but their 52-week high was at $37. PE ratio is at a nice 24, so this would be a good company to invest in. Now, last but not least, this is the company that I'm most excited about, and if you stuck around to the end, thank you for watching. Subscribe if you like more videos like this, and don't forget to smash the like button. So, last one here, steady dividend growth. WP Carey is a diversified REIT that owns operationally critical properties in the industrial, warehouse, office, retail, and self-storage sectors. Now, that's a lot of sectors for the property back to the operators under the triple N lease, right? So they have to pay those triple net leases. Those leases supply it with stable rental income to support its 5.4 dividend yield. Now, why do I like this one so much? Because it actually has increased its payout since 1998. 1998, guys, it has been increasing its dividend payout. So who knows how much longer and farther this can go in the future. Many years, I believe, in the future, this will stay paying dividends. So the dividend continues to grow in the future. WP Carey has a reasonable dividend payout ratio and solid balance sheet to fund acquisition. After buying a record $1.7 billion of property last year, WP Carey expects to acquire $1.5 billion to $2 billion in real estate in 2022. That is just amazing. In addition, it's purchasing a net $2 billion of property by acquiring real estate funds it currently manages. These deals will boost its rental income, giving WP Carey more cash to grow its dividends. Now, Great ways to boost your passive income for sure with these REITs. These are the top 5 REITs. I believe they're more than above average dividend yields compared to a lot of the other broader stocks in the market. However, some REITs stand out from the pack, like EPR Properties, Medical Properties Trust, SL Green Realty, Store Capital, and last but not least, WP Carey. These all yield more than 5%, with one being as high as 6.3%. Even better, all 5 REITs should be able to grow these payouts in the future and steadily pay out these over time. That makes them great options for investors seeking to boost their passive income monthly as well as quarterly, and growing and appreciating their stocks in the future as time goes on. So guys, I hope you enjoyed this video. This was just a quick video to show you guys some stocks that you can get into, and not bad on some of the share prices. You can get on all these companies for less than $100. None of these companies had a share price higher than $100. So if you guys liked this video, don't forget to subscribe and smash that like button. You guys have a great day.